But my next guest is staying bullish, reiterating her buy rating on the stock, maintaining a $45 price target, about $9 above where we are now. Lorraine Hutchinson is BofA's senior retail analyst. Lorraine, it's interesting because they have relatively small exposure to China, right?
They do. And in fact, the guidance came in a little bit below consensus, not because of tariffs, though. So the two reasons why the guidance came in below where we're expecting is, number one, they only put about half of the buybacks into the guide that we were expecting. What this means is they'll have $300 million of dry powder which they can use to either buy back stock or pay down debt as the year goes on. The second thing is some incremental IT investments that we didn't have in our model for the back half of the year. Both of those things, to me, are easily fixable. I think what is important here, and I think what's interesting about the stock today, is it's sitting at a 10 PE. There's a 10% free cash flow yield. They talked about the quarter being off to a great start, and they guided sales growth positive for the first time in several years. So we think this is a great buying opportunity today on the weakness.
I love it when you come on and say, listen, it's almost like you're more confident than the company's own management is, which is ironic, although maybe they're just being super conservative. One note of caution could be their exposure if we do get a universal tariff. But even then, 85% of their production is in North America. They should be completely insulated.
Yeah, I don't really think the tariff story is a big story for BBW today. I think it is the conservative guidance that's getting people a little bit nervous. And look, if I were a management team guiding today for this calendar year 25, I'd be conservative too. We don't know what's going to happen, what the consumer impact of these tariffs will be. And what we've heard so far, remember, we're very early into consumer earnings season. What we've heard so far is the companies providing a more cautious tone because the customer is looking right now, they're looking for value, they're looking for great deals, and they're bracing themselves for higher prices. So I think that what we'll hear for the rest of consumer earnings season is a relatively cautionary tone on the top line. And the places we want to be are where there's a product that the consumer really wants. And I think if we're looking at Bath & Body Works, that's a Disney collaboration that they launched a week and a half ago that is getting rave reviews. So I think they have a lot of momentum right now, but they're reluctant to build that into their full year guidance.
One more, and I don't want to harp on this, we can move on, but when we say that 85% of their sourcing exposure is North America, look, could that make them vulnerable in the case of tariffs on Mexico and Canada?
Yeah, if you look at Mexico and Canada, each are about 3.5% of their imports. So relatively small exposure. I would say, in the case of a 25% tariff, it would only be about 20 to 30 basis points of margin impact.
All right, then I take your prevailing point, and I'm going to be watching on Reels for the Disney collab to see if that is gaining some broader traction. So who else do you think is actually quite exposed, maybe a little bit of caution, and who else do you think has the right product mix that can carry them through what could be a tough year?
We continue to think off-price is well-positioned in an environment where tariffs continue to build. They buy very close to need. So most of what they buy is domestic already, so it's imported already. They're not the payer of record on tariffs. And they can zig and zag into the products that are working at really sharp value price points. And that's what the consumer's looking for. We heard from TJX yesterday with a really good fourth quarter and a solid guide. They have a lot of confidence in their ability to offset this. So that's really where I would focus because of their resilience and how quickly they can move around from country to country or product to product.
And finally, who else has, I don't know if you would say, by default, if they have high China exposure, you're cautious, or if it's just a coincidence, but what would be some of the names on that list? High
China import exposure is almost a thing of the past for retail. If you look across my entire group, they have reduced their China exposure to less than 10% of their U.S. imports. Why did they do this? They did this because of the 2018 and 2019 tariffs were so costly when they were initially enacted that they shifted very quickly to other areas of Southeast Asia. I think the biggest risk to my group is a universal tariff where all imports are taxed. Then we could see a lot of margin pressure. But if it's simply China, we think it will be manageable.